Can you substitute a duration or a stasis in Fed policy for going up to a higher rate? Can you actually get away with that shell game?
It depends on what we're looking at today in the data and what it implies about inflation. Today's about, wage inflation, and, can the Fed get away with a pause is really about whether they're making good on the inflation trajectory as the market is expecting it to decline. So they'll pause if inflation is declining, but they won't be able to if they're not achieving their inflation objectives. I just want to comment a second on the report is mixed between the unemployment rate and the wages. As we have seen for a number of reports, the payroll report has really become kind of the stepchild of economic reports relative to next week's CPI. So what's really important here is what can we look through into this report as to what it says about inflation. And obviously the headline on that is average hourly earnings, and that's a little bit positive. But what I want to highlight out of this report is something we haven't talked about yet. The big expectations in inflation is that you have this persistent expectation that goods deflation is going to support the consensus expectation for declining inflation. The one thing out of today's payroll report I think that's interesting to highlight is that if you look at the goods components, wholesale trade, retail, transportation, those are up total 26K in terms of the monthly payroll gains. That's a significant change relative to the pace of about a 3-month average of -4, 6-month average of around 6. And if you look through and you squint a little bit, it is worth noting that this is a little bit of a different story, that we've had an expectation that the good side is deflating. If you look into today's payroll report, it tells you a little bit of a different story, that maybe you're seeing some signs of life in the goods. If we see that into next week's CPI report, that's going to be a big change relative to market expectations. I think that's one of the interesting takeaways from today's payroll report.
People don't do nuance well, Jeff, especially after living under the Fed's thumb for so long in terms of don't fight the Fed. So there is a question of, as you parse through the nuances of this data, what do you do? How does it shift what you actually do in the markets, what you buy, what your thesis is for 2023?
Yeah, well, this is the thesis for the market consensus thesis, is that goods deflation is supporting the peak inflation expectations. That supports the Fed pause and really feeds into the market, the bond market expectation that the Fed can pivot. So you have the tension is really on the services inflation. Today on the headline, you get a little bit of support for that because you see average hourly earnings coming down. But this is still a strong labor report. It's still a strong labor market, and we are not yet seeing a significant tightening in labor markets from the significant tightening in interest rates. That may be lags, but it may also point to a lack of interest rate sensitivity in the broader economy outside obvious candidates like real estate.